Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another intense analytical session.
We certainly have a heavyweight for you today. We're climbing aboard one of the most one of the most difficult to analyze infrastructure assets in North America. We're taking the train.
That's right. Today we're breaking down Canadian National Railway, CN, a critical piece of the continent's economic machinery. On the surface, it's just the definition of a blue-chip stock, an asset of legendary quality, known for its resilience and its quasi-monopolistic positioning.
CN is the ultimate physical fortress. But here's the central question for us, and for any sophisticated long-term investor, it's the one that makes this a real puzzle. CN perpetually trades at a steep premium valuation. Does the company's unreplicable physical moat, this competitive fortress built on steel and concrete, still justify the consistent price the market demands?
Exactly. Or, and this is what we really need to dig into, are the structural risks of, say, regulatory intervention or volume ceiling limitations tethered to GDP, and the inevitable accelerating pressure of decarbonization. Are those risks being fundamentally overlooked by the consensus view? That's what this deep dive will uncover. We're hunting for the true margin of safety here.
That's a massive question, and it's one that requires a multi-decade analysis, not just looking at a quarterly earnings review. And before we get into the extensive details, just a quick note for everyone listening.
For those of you who want to act on these investing ideas, or even just track these complex movements and metrics like operating ratio and ROIC, having a professional-grade platform is absolutely key. We rely on interactive brokers for our own analysis, and we've partnered with them to get our listeners a stock bonus when they sign up and fund their accounts through our dedicated link.
So you get a stock bonus, and you directly support the research that goes into these deep dives at the same time. That link is right in the description below. It's the easiest way to find it.
And of course, if you find value in this kind of in-depth, long-form analytical discussion, the kind of content that really forces you to think differently about compounding, the best way to let us know, and to make sure you don't miss the next one, is to subscribe, like this deep dive, and ring that notification bell. It truly helps the channel grow. And if you have any questions about CN, or if you hold the stock, please manifest yourself in the comments section.
Perfect. Now let's jump straight into the material. We'll begin with pillar number 1, the unreplicable fortress. We really need to define the business model and, understand the breadth of that extraordinary moat.
Okay, let's unpack this business model. When we look at Canadian National Railway, we are looking at something elegantly simple and utterly non-negotiable in the global economy.
That's a good way to put it.
CN functions as the elemental, mass-moving arteries of the North American economy, responsible for relying on the enduring need to move incredible weight from point A to point B.
And the scale is just staggering. They move roughly, 170 billion Canadian dollars worth of physical goods across their network in any given year.
$17 billion. Still, an immense number.
Right, sorry. See $17 billion in revenue from those goods. And the quality of this business is immediately apparent when you look at that revenue mix. It's exceptionally balanced, and that balance is a primary driver of its stability.
Can you break down that mix for us? Because having a balanced commodity exposure seems crucial for mitigating cyclical risk.
Absolutely. And it's something they've managed very well. No single segment dominates. You've got intermodal, which is, tied to global container movement and consumer spending. Then you have your foundational commodities.
The heavy stuff.
The heavy stuff. Grain, tied to global agricultural demands. Petroleum and chemicals, feeding North American industry and energy needs. And then you have forest products, metals, and automotive.
So what does that balance do in a real-world scenario?
It means that if, for example, automotive sales dramatically slow down, which is a classic cyclical event, the strength in, say, robust grain harvests or international petroleum movements often compensates. It acts as a built-in shock absorber against localized economic downturns. It smooths out the earnings profile beautifully.
And the entire model is founded on a principle that's, it's older than the internet and probably older than most of us. The physics advantage. It's a bet on the physical economy, not on some transient technology that might be obsolete tomorrow. Why is steel on steel still the defining edge?
It is the foundational competitive advantage, and it's simply non-negotiable for high-volume, long-distance movements. We're talking about basic physics here. Steel wheels on steel rails generate vastly less friction than rubber tires on asphalt.
It's just more efficient.
It's incredibly more efficient. The result is that rail transport is somewhere in the range of 3 to 4 times more fuel efficient per ton mile than moving the same cargo via truck.
So for bulk commodities, things like coal, grain, or oil, where costs are constantly under the microscope, the rail system isn't just a cheaper option. It's the only financially viable option for moving them thousands of miles.
Precisely. That cost advantage is structural, it's permanent, and it's pretty much impervious to short-term technological shifts. I mean, even if the trucking industry fully transitions to electric or hydrogen power,
They still can't beat physics.
they still can't overcome the fundamental physics of friction. This guarantees rail's dominant position in the bulk segment for the foreseeable future, and that provides CN with a very, very resilient earnings floor.
Okay, so if the business model is simple and enduring, let's move now to the actual competitive fortress, the tri-coast moat. We need to be crystal clear with the listener. CN owns a physical asset that is utterly unreplicable. Why can't a competitor just build a parallel rail line today?
It's impossible. I mean, for all practical purposes, it's impossible. The primary asset, the track network and the right-of-way, is a permanent physical monopoly enforced by practicality and by regulation.
Just walk us through that. Imagine I'm a billionaire and I want to compete.
Okay. Imagine trying to acquire the thousands of miles of continuous land, conducting the environmental impact studies, gaining regulatory approval from multiple layers of government across 2 different countries, not to mention enduring the political and public resistance. The capital required is in the hundreds of billions, and the political and regulatory hurdles are, well, they're infinite. It just cannot be done. CN's tracks are essentially a legally sanctioned permanent monopoly.
But within that monopoly structure, every major class and railroad has its own fortress. What makes CN's specific fortress, this tri-coast connection, the single most potent competitive advantage in North America?
It all comes down to the geographic integration. CN connects the 3 major North American trade arteries: the Pacific Coast, the Atlantic Coast, and the Gulf of Mexico. This isn't just a wide physical moat, it's a deep integrated system that offers unparalleled operational flexibility.
It looks like a giant T on the map.
It does. It looks like a massive T-shape, and that provides incredible east-west fluidity combined with those crucial north-south linkages down into the U.S. heartland and the Gulf.
Okay, but now we have to talk about the recent CPKC merger. That created a fantastic north-south vertical rival, linking Canada directly to Mexico. So why does CN's T-shaped tri-coast network still retain a unique, arguably superior advantage?
Look, the CPKC network is a magnificent achievement, no doubt. It's optimized that north-south spine. But CN's unique advantage lies in its east-west capacity and its redundancy across all 3 major trading fronts. The ability to pivot cargo across 3 oceans, the Atlantic through Halifax, the Pacific through Vancouver and Prince Rupert, and the Gulf through Mobile and New Orleans, means CN can navigate congestion, weather, or geopolitical risks far better than any rival. It's an optionality that none of its peers can truly match.
Let's translate that optionality into real economic power. Let's use a specific example, the single-line haul advantage. Take a Canadian potash or grain producer way out in Saskatchewan or Alberta.
Right. That producer needs to export bulk goods, maybe to Asian or South American markets. If they contract with CN, CN can load the cargo and route it seamlessly. They could send it west to Vancouver or Prince Rupert on the Pacific.
But what if those ports are congested? Which happens all the time.
Exactly. If they're congested, CN can pivot immediately and send it east to Halifax on the Atlantic, or even south down to a Gulf port. The key, and this is the most important part for investors, is that CN controls that movement from start to finish.
Why does that matter so much to an investor who's just focused on the profit margin?
It matters because of something called the handoff. When CN can execute a single line haul, 100% of the freight revenue stays on CN lines. They capture the entire profit margin for that move.
And their competitors.
Well, if that same producer had to use a competitor who only connects to, say, the Pacific, and that port is full, the competitor would be sourced to execute an interchange or a handoff with another railroad to reach the Atlantic or the Gulf.
Which sounds inefficient.
It introduces immense friction. You have latency, paperwork, potential points of failure, and most critically, a mandatory profit-splitting agreement. CN's single line ability is a powerful pricing lever and a margin protection mechanism.
Can you put some hypothetical numbers on that difference? How much more margin is CN capturing on an average single-line haul compared to a typical two-railroad interchange?
Well, the exact numbers vary wildly by commodity and distance, but you can safely estimate that an interchange generally reduces the profit captured by the initial railroad by anywhere from, say, 20% to 40%. It depends on which carrier covers the most distance. The single-line haul bypasses that entire dilution of profit.
So for a typical movement from Calgary to the port of Prince Rupert, CN is maximizing that margin.
Completely. Whereas if that same cargo had to move via two carriers, the process could add days of latency and significantly depress the profitability for both of the carriers involved. CN's network is built to minimize that inherent industry friction.
So what does this extraordinary competitive position mean for our analytical frameworks? CN perfectly embodies two critical mental models that define enduring business quality. First, the classic Warren Buffett idea of the toll bridge.
The toll bridge model is perfect for this. It suggests that if you own the exclusive, necessary infrastructure, the only viable pathway, you possess the power to charge a consistent rising toll for its use. Now, CN does operate under governmental regulation in both Canada and the U.S.
By the Canadian Transportation Agency and the Surface Transportation Board, the STB.
Right. But the principle remains ironclad. Shippers must use their tracks for bulk transport. This reality translates into consistent, long-term pricing power that generally allows CN to raise its rates above the rate of inflation, ensuring margin stability and growth.
But let me challenge that for a second. If they are a toll bridge, isn't the STB the government official sitting at the gate with a hand on the lever, ready to cap those tolls if the railroad gets too greedy? Doesn't that threat of regulation structurally limit their upside?
That is the essential trade-off, and we will absolutely address it fully when we discuss risks. Yes, the upside is capped by regulatory oversight. They can't engage in true monopolistic pricing. But the downside is also protected. Regulation generally ensures the viability of the infrastructure because it recognizes its national importance. It's a regulated monopoly, which means consistent, predictable earnings are favored over explosive, volatile profits. You trade the chance of earning a 40% ROIC for the certainty of earning, say, 14% ROIC every single year.
The second model is one that's often discussed in the context of system resilience, the Lindsay effect, which is often related to anti-fragility. How does CN's physical network provide that kind of redundancy?
Well, rail operations are inherently exposed to volatility of derailments, severe winter weather, and most frequently, labor disruptions at major ports. A single coast railroad, if its key port is shut down by a strike, faces a structural impairment. Their entire business model just stops until the issue is resolved and they hemorrhage margin. CN is different.
Give us a specific recent scenario where this anti-fragility kicks in.
Look at the Port of Vancouver. Labor strikes among the longshoremen are a common occurrence, sometimes lasting for weeks. If CN relied solely on Vancouver for its high-value intermodal traffic from Asia, a strike would be catastrophic.
No, they don't.
Exactly. Because of the three-coast network, CN can instantly reroute high-value goods, electronics, auto parts, consumer containers up to Prince Rupert, which is a less congested and strategically critical port further north. Or they could even pivot that traffic completely across the continent to Halifax. This is disaster mitigation that's literally built into the physical asset. It allows CN to preserve shareholder value and maintain customer relationships where a less diversified peer would simply be shut down. This redundancy is what makes the asset anti-fragile.
Now let's inject some human reality into this massive infrastructure story. We need to check the scuttlebutt. What are the customers and employees actually saying about CN on the ground? Let's start with the customers, the shippers, who are paying that toll.
Customer sentiment is a perfect demonstration of the necessary evil relationship that defines these regulated infrastructure monopolies. Shippers view CN, and frankly the entire rail industry, as a necessary evil. They complain constantly, and often rightly so, about service delays, particularly during severe Canadian winters, which can absolutely choke track velocity, and they particularly hate the demurrage fees.
Demurrage fees, those are essentially the fines the railroad charges the shipper for not picking up or unloading the rail cars quickly enough, correct?
Exactly. From CN's perspective, demurrage is a necessary operational tool to maximize asset utilization. They want those cars moving, not sitting idle on a siding taking up space, but shippers view it as a frustrating and sometimes unfair profit center for the railroad.
So you see a lot of friction there.
Ugh, constant complaints and trade publications about these fees. Shippers often cite frustrating delays in getting the car spotted or picked up on the railroad's end, only to be charged the fee anyway. The relationship is contentious.
But they tolerate it. Why don't they just switch to trucks?
Because the financial reality is undeniable. As we established, trucking is just vastly, prohibitively more expensive per ton mile for bulk goods. For a shipper of 5,000 tons of potash moving 2,000 miles, there is no viable economic alternative to rail. So they will complain, they will lobby the government for regulation, but ultimately they sign the contract with the railroad because their business literally depends on CN's structural cost advantage. The price power of the moat overwhelms the customer service frustrations.
Let's turn to the employees, which brings up the massive industry-wide operational philosophy of precision scheduled railroading, or PSR. PSR is meant to maximize efficiency, but it has driven intense polarization among the workforce.
PSR is an operational methodology that's focused on maximizing asset utilization. It means running fewer, longer, rigidly scheduled trains and minimizing crew idle time. Financially, it's been brilliant for lowering the operating ratio. Humanly, it's brutal.
What do you hear from the crews?
Train crews criticize the lifestyle intensely. They cite chronic fatigue, irregular hours that constantly disrupt family life, and extremely strict attendance policies designed to keep staffing as lean as possible. The pressure to perform in a high-risk environment is just immense.
Yet when you look at the data, you see incredibly long tenure. What is the golden handcuff reality that keeps employees on the rails despite these deep operational complaints?
It's the compensation package. The pay, particularly for long-serving engineers and conductors, is universally praised. It puts them firmly in the middle to upper middle class, often without a four-year degree. And crucially, the pension and healthcare benefits are exceptional, a true rarity in today's economy, especially in blue-collar sectors.
So they stay for the security.
They do. So while the operational complaints are very real, the financial security provided by the high pay and robust benefits leads to extremely low turnover among veteran staff. And this long tenure, paradoxically, maintains a high level of institutional knowledge and technical expertise within the company, despite the short-term pressures of PSR.
That sets the stage beautifully. We move now from the physical asset, the fortress, to the quality of people running it and their capital allocation discipline. Pillar 2 is about financial DNA and operational stewardship. An incredible asset can be absolutely destroyed by poor management.
This is the acid test, isn't it? CN's historical success is not just about the tracks. It's about the fact that it has generally been run by operators with very high financial discipline. Let's start with the strategic shift under the current CEO, Tracy Robinson, who took the helm in 2022.
Her philosophy represented a subtle, but I think necessary course correction away from the prior almost militant focus on efficiency at all costs that defined the peak PSR years across the industry.
Right. Her focus is on scheduled growth, which means prioritizing service reliability over simply slashing the operating ratio, or RR. The realization was that maximizing efficiency is counterproductive if you alienate your key shippers and drive high-margin intermodal traffic onto trucks because your service is unreliable.
So what does that mean in practice?
Her management philosophy emphasizes the core operating metrics that actually matter to the customer. Restoring reliable service, increasing average track velocity, how fast the train is actually moving, and reducing dwell time, how long a car sits waiting to be picked up or dropped off.
But let me challenge that phrasing, scheduled growth. To a cynical investor, that might sound like management speak for slowing down necessary cost-cutting and allowing the operating ratio to creep up slightly. Is this a genuine shift in culture, or is it just a temporary pause on discipline?
I think it's a genuine long-term shift that recognizes the inherent limitation of PSR. You can only cut costs so far before you begin consuming the quality of the asset and the service itself. The ultimate goal isn't the OR number itself, it's maximizing revenue capture.
It's about growing the pie, not just slicing it thinner.
Exactly. Winning back share from the trucking industry is a growth strategy, and the only way to do that is to ensure shippers have certainty. If a shipper can rely on a precise schedule, they can integrate rail into their complex supply chain planning, which makes them more willing to move slightly higher value goods back onto the rails. It's a focus on long-term profitable volume over short-term headline efficiency metrics.
For investors in capital-intensive businesses like rail, management's discipline in deploying capital is probably the single greatest determinant of long-term returns. Let's look at CN's rational hierarchy for capital deployment.
The hierarchy is simple, clear, and non-negotiable. The foundational requirement is always maintenance CAPEX. This is just the cost of staying in business. CN has to spend upward of $3 billion annually just to maintain the quality of the Steel River.
That's not growth spending.
Not at all. That's ensuring tracks are safe, replacing ties, performing necessary bridge and tunnel work. You simply cannot defer this spending without inviting catastrophic operational failure or massive regulatory fines.
This brings up the Red Queen effect. Can you explain how this high capital intensity acts as a permanent drag on growth capital, even for a high-quality business like this?
The Red Queen hypothesis, which is adapted from biology, basically states that you have to run as fast as you can just to stay in the same place. In CN's case, that $3 billion or more is not growth capital, it is sustaining capital. It's required simply to keep the existing infrastructure from deteriorating.
So it's a tax on cash flow.
It is. It's a perpetual tax on free cash flow, ensuring that CN will never be a highly capital-light business like a software company. It limits their compounding rate compared to a more asset-light model, which is a structural reality every rail investor has to accept.
After sustaining the network, the focus shifts to returning capital to owners. What signals does CN send through its return strategy?
First and foremost is the dividend. CN boasts a phenomenal 28-year streak of consecutive dividend increases. This is a crucial signal. It tells the market, we are a utility-like business with highly predictable, recession-resistant cash flows, and management is committed to a stable, rising income stream for you.
And after the dividend?
Following that, when operating conditions are strong and free cash flow generation is high, management tends to be aggressive and rational with share repurchases. They reduce the share count, which boosts earnings per share for the long-term owner.
But the ultimate rationality test for management discipline that came during the bidding war for Kansas City Southern, KCS, a few years ago.
This was the defining high-stakes moment that separated financially disciplined management from empire builders. KCS offered a phenomenal opportunity to create the first single-line network stretching across Canada, the U.S., and Mexico. CN was deeply involved, but when the price accelerated, driven by CP's aggressive counterbid,
They walked.
they made the excruciating, but in retrospect, brilliant decision to walk away.
Why does refusing to acquire a strategically valuable asset deserve a gold star from the perspective of a disciplined investor? It seems counterintuitive.
Because the price that CP ultimately paid involved significant debt loading and dilution, which fundamentally lowered the return on invested capital for the combined entity. CN management, by refusing to overpay, prioritized shareholder ROIC over simple size and scale. They avoided taking on massive leverage and the long, painful integration stress that followed the deal. That single decision to conserve the balance sheet and protect their existing high-quality returns is a powerful testament to their discipline and their alignment with long-term owners.
And that alignment is also evident in how they incentivize their leadership team, right?
Absolutely. Executive compensation is tightly aligned with long-term metrics, specifically return on invested capital and key safety metrics. They are not paid just on growing volume, they are paid on efficiency and true economic value creation. And it's also worth noting the quality of their institutional ownership. This is a stock held by some of the most disciplined, capital-allocating institutions in the world, including Bill Gates' Cascade Investment, which signals deep confidence in the stewardship.
Let's delve deeper into the quality of the balance sheet. What defines CN's financial DNA?
I think the keywords are consistency and resilience. CN is a bedrock of stability. We can look at their performance during massive economic shocks. In the 2008 global financial crisis, while volumes dipped, the company remained highly profitable. In the 2020 pandemic lockdowns, they continued to generate massive cash flow. This is because the fundamental need for mass transit doesn't disappear, it just slows down temporarily. CN doesn't swing wildly into losses, it reliably generates cash, making it a perfect low-volatility anchor in a long-term portfolio.
Okay, let's focus on the key quality ratio, return on invested capital, or ROIC. This is what proves they are creating true economic value above their cost of capital.
This is the crux of the matter, really. CN historically averages an exceptional 12% to 16% ROIC. And to understand why this is so critical, you have to compare it to their capital, which typically sits in the mid-single digits, maybe 5% to 7%. That spread, the distance between what they earn on capital and what capital costs them, is enormous for an infrastructure business.
And why is that spread structurally superior to, say, what you might see in a manufacturing or a retail business?
It's because of the moat and the asset life. A manufacturer might hit a 20% ROIC temporarily, but competition will quickly bid that down as rivals enter the market. CN's assets, the tracks, are permanent and protected by the regulatory environment. They can reinvest a dollar of retained earnings back into their protected network and consistently expect a 12 to 16-cent return with very low volatility. That makes it a powerful, reliable, compounding machine over decades.
And how efficiently does that accounting profit, the net income, convert into tangible cash flow?
The free cash flow conversion is high, which is excellent. They aren't burdened by major working capital swings. However, and we have to constantly return to this point, the capital intensity is real. While the quality of the cash flow is high, the absolute quantity of cash flowing out the door for sustaining CAPEX is a permanent reality. Management has to be vigilant to ensure every dollar spent on CAPEX is maintaining that 12–16% ROIC and not just, running to keep up with the Red Queen.
Finally, let's talk balance sheet prudence. A utility or infrastructure business can handle more debt than a growth tech company because its cash flows are so predictable. What's CN's comfort zone for leverage?
They maintain net debt to EBITDA typically in the prudent range of 2.0x to 2.5x. For a business with this utility-like predictability and revenue resilience, that level of debt is entirely appropriate. It allows them to use leverage conservatively to enhance equity returns, but it keeps them far, far away from any distress scenario. It provides ample flexibility to invest counter-cyclically during economic dips, or to execute buybacks when the stock is temporarily depressed.
Now we move into Pillar 3, valuation, risks, and the margin of safety. And this is the hardest section to reconcile because all the quality metrics, the moat, the ROIC, the discipline, they all scream buy, yet the stock price always seems to scream expensive.
That is the investor's eternal dilemma when you're dealing with a super quality asset. CN is rarely, if ever, cheap. It typically trades at a premium. We're talking 18x to 22x earnings, sometimes higher relative to the broader market, and certainly compared to cyclical industrials. The market is paying up for certainty. They are paying for long-duration cash flows and for a tangible asset base that acts as an excellent inflation-protected hedge.
So if the multiple is structurally high, how do we define the margin of safety for a CN investor? It can't come from a low PE ratio alone.
Correct. For CN, the margin of safety must be sought during transitory operational crises. We are waiting for the market to panic about a problem that is short-term, fixable, or weather-related. The market is phenomenal at pricing 30 years of predictable cash flow, but it is terrible at pricing a single quarter of operational chaos. That temporary dislocation is your entry point.
Can you give us some concrete historical examples of these optimal entry points? What specific events have historically created those troughs of temporary undervaluation?
You look for the inevitable bad news cycle. We've seen it during major labor strikes that halt service for several weeks. We've seen it during periods of unusually harsh and prolonged winter weather across the prairies that just destroy track velocity for an entire quarter. Another historical trigger is a temporary regulatory scare, for instance, when the STB makes threatening noises about mandating competitive access or capping rates.
So you buy when everyone else hates the stock for short-term reasons.
Historically, that has been the winning strategy. Buying CN when it is hated for these service issues, when the OR temporarily spikes and earnings dip, the issues are temporary. The moat is permanent.
So the mechanics of the return are entirely dependent on that entry multiple. Detail the expected return difference for the listener based on where they decide to buy.
If you buy CN at the high end, say greater than 25 times earnings, when everything is perfect, the economy is humming, and service is stellar, you are paying full price for future compounding. Your returns are likely going to mirror the general market, maybe a 6% to 7% compound annual growth rate. It's safe, but it's not alpha generating.
But executing that buy the crisis strategy, waiting for that sub-18x earnings multiple.
That's where you can generate significant alpha. At the crisis multiple, you get what I call a triple kicker. First, you benefit from the multiple expansion as the stock reverts back to its 20x average. Second, you get the consistent dividend growth. And third, you capture the operational recovery as things normalize. That combination can potentially generate a 12% to 15% CAGR, turning a highly stable utility into an exceptional long-term compounder.
Let's pivot to growth. Where does the volume expansion actually come from?
The volumes are structurally tethered to North American GDP and population growth. This makes CN a predictable but ultimately slow grower. They are not a hypergrowth tech story. The primary engine of shareholder return, therefore, is not volume. It's consistent pricing above the rate of inflation. Their single-line haul advantage and the competitive scarcity of their network grant them the leverage to raise rates consistently and push costs through to the customer.
Okay, now we have to confront the permanent impairment risks, the threats that could structurally dilute the moat, not just temporarily depress the stock price. Let's start with regulatory cap risk, which you mentioned earlier.
This is the most significant, ever-present threat. The regulatory environment is key, particularly in the U.S., where the STB has broad powers. We worry about government intervention in two primary forms. First, direct rate intervention mandating a cap on how much they can charge for certain key hauls, which restricts that critical pricing power.
And the second form, which is potentially more damaging, is forcing interswitching. Can we elaborate on the specific mechanics of forced interswitching and why it attacks the very core of the moat?
Interswitching, or reciprocal switching, basically means forcing CN to allow a competitor's railroad to use CN's tracks for the final mile to a customer's facility or critical port. Historically, CN could charge a premium because they own that final protected stretch of track.
It's their property.
Exactly.
Yep.
If the government mandates interswitching, it essentially monetizes CN's hard-won infrastructure for the benefit of its rivals. It would eliminate the single-line haul advantage in key areas and permanently dilute the moat by enforcing profit splitting where none was required before. It's an effective expropriation of economic value from CN shareholders.
The second major threat relates to the core business of moving international goods, deglobalization risk.
This is a risk tied directly to the geopolitical climate. CN's highest margin, highest quality volumes flow through its jewels, particularly the ports of Prince Rupert and Vancouver, connecting North America to Asia. These intermodal boxes are incredibly profitable.
And if that trade slows down?
If global trade friction increases, if tariffs rise, or if there is a severe structural contraction in North American trade with Asia, those high-margin international intermodal volumes would suffer permanently. That is a direct structural threat to the quality of the cash flows that underpin CN's premium valuation.
Assuming those permanent risks don't materialize, what are the near-term operational catalysts that could re-rate the stock, pushing it back toward or even above that historical premium multiple?
The first major focus is operating ratio, or OR, improvement. This is central to CEO Robinson's Plan 2026. The operating ratio is the industry's obsession. It's just expenses divided by revenue. A lower OR signals higher efficiency and better cost control.
And the math here is brutally effective because any improvement goes straight to the bottom line.
It's direct margin expansion. Every 1% drop in the operating ratio falls directly to earnings per share. Plan 2026 aims for material, measurable improvements in track velocity, longer train length adherence, and reduction of crew utilization costs. If they can execute this plan successfully, for example, dropping the OR from 60% to 58%, that 200 basis point drop translates directly into material earnings growth without needing to rely on a booming economy for volume.
The second catalyst seems tied directly to the economic cycle, intermodal recovery.
Yes, intermodal container movements, which are heavily tied to consumer durable goods spending, are highly cyclical. Post-pandemic, we saw disruptions followed by a contraction as consumer spending shifted back towards services. When consumer goods spending rebounds, when people start buying new furniture, electronics, and imported consumer goods again, that will disproportionately boost CN's intermodal business. This high-margin volume recovery will drive high-quality earnings growth and send a strong signal to the market that the cyclical trough is behind them.
Let's wrap this pillar with the essential second-level thinking inquiry. The consensus view, the surface analysis, is that CN is merely a simple play on Canadian GDP and commodities. How do we move beyond that pedestrian assessment?
The second-level thought is that CN is fundamentally a supply chain resilience asset. We need to look beyond just Canadian GDP. As global supply chains face increasing friction, geopolitical conflict, trade wars, climate change disruptions, companies are desperate to reduce complexity and risk. This is driving the global trend of nearshoring manufacturing back to North America, particularly to Mexico and the U.S. South.
And how does that nearshoring trend specifically leverage CN's T-shaped network?
Well, when a company decides to move production from Asia to, say, Monterrey, Mexico, they need efficient, reliable transportation to get components and, crucially, finished goods to the massive consumer markets in the Canadian and U.S. Midwest. While CPKC dominates the spine to Mexico, CN's network is perfectly positioned to capture the fluid distribution from the U.S. Gulf Coast and central states across the continent.
So the chaos elsewhere makes them more valuable.
Exactly. The resilience of that tri-coast connectivity, the ability to pivot rapidly, becomes a premium feature for manufacturers who can no longer tolerate the risks inherent in deep-sea shipping and complex multimodal routes. It makes CN more strategically valuable in a fragmented world, not less.
That's a powerful reframing. Fiction outside North America elevates the value of the stability and efficiency inside North America.
Yeah.
CN is selling stability, not just track miles.
Precisely. They're selling certainty in an increasingly uncertain world, and the market should, in theory, pay a premium for that structural resilience.
This has been an incredibly detailed breakdown of the moat, the stewardship, and the risks. Let's move into our final segment, where we synthesize the full picture and confront the largest, most structural risk that is often overlooked in near-term forecasts.
Right, we need to pull this all together into the one-pager investment thesis for the listener.
Start with the bull case recap. Why does this company command such a premium valuation?
Okay, 4 things. First, the unreplicable asset. The Tri-Coast network provides a physical, competitive moat that simply cannot be duplicated. Second, proven pricing power. CN has the ability to consistently pass inflation costs to customers, which protects real returns. Third, exceptional capital discipline, evidenced by management's refusal to overpay for KCS, which preserved the high ROIC. And fourth, a historical efficiency culture, which makes them one of the most operationally efficient railroads in the entire sector.
The bear case recap. What are the clear, measurable forces pushing against that premium?
3 main points here. We have the growth ceiling. Volume growth is tethered to slow, predictable GDP growth. It is not a high-growth stock. We have regulatory hostility, the constant existential threat of governments capping rates, or, even worse, mandating track access through interswitching. And finally, capital intensity. This is that Red Queen effect, requiring massive, consistent capital expenditure just to maintain the quality of the infrastructure.
That brings us to our final red team challenge. The structural risk that often gets buried in the footnotes of long-term forecasts. The decarbonization risk. This is the implicit bet every long-term CN investor is making today.
This is the critical blind spot. We have to analyze the current revenue stream and face the reality of its composition. Approximately 20% of CN's current revenue, a massive, predictable, and historically high-volume chunk, comes directly from fossil fuels. That includes coal, petroleum, and frac sand.
So this means an investment in CN today is an implicit bet that the global energy transition will not accelerate rapidly enough to structurally strand these transportation assets before the investor realizes their required return. It's the Kodak risk, but applied to physical infrastructure.
That's a perfect analogy. Kodak was brilliant at making film, but the underlying technology, chemical film, was structurally obsolete. CN is brilliant at moving bulk goods, but approximately 1/5 of its bulk goods volume is sitting on a potentially finite structural timeline, and that timeline is being dictated by global climate and energy policy.
The company's rebuttal is logical, though. They argue they can replace these volumes with the movement of green metals, things like copper, lithium, structural steel, and all the materials required for electrification and renewables.
And that is a sound theoretical argument, but it hits a huge volume density problem in reality. Coal and oil move in immense, consistent unit trains. Their volume density is exceptional, which translates to predictable, high-frequency, high-revenue movements. You can move one train full of crude oil, and that generates massive, consistent revenue.
But to fill that 20% revenue gap, you would need many, many more trains of relatively less dense products, like containerized lithium or specialized copper transports.
The transition risk is immense, because the replacement rate might not match the depletion rate. If Canadian and U.S. governments accelerate their efforts to phase out coal exports or limit pipeline capacity, that 20% volume could structurally vanish faster than CN can replicate it with greener, but often lower volume density materials. The long-term valuation of CN rests on the assumption that they can manage this multi-decade volume transition without serious structural margin degradation.
That brings us back full circle to our initial question regarding the premium valuation. If the physical moat, the Tri-Coast network, is indeed unreplicable and the cash flows are certain today, the true question for the long-term owner is this. How many years of consistent rising dividends are you, the investor, willing to pay for, knowing that 1/5 of the current revenue stream is sitting on a finite, structural timeline dictated by the speed of the global pivot away from its legacy cargo?
The future of CN's valuation lies not just in its pricing power and operating efficiency today, but in management's ability to navigate that generational energy transition and successfully replace that legacy high-density cargo with the commodities of the future. That is the long-term factor that demands the most scrutiny, and it's where the true test of this quality asset will ultimately occur.
A truly fascinating and deep dive into one of North America's foundational businesses. Thank you for joining us today for this intense analysis of Canadian National Railway. We will see you next time for another deep dive.